Today we're looking at crude oil's Tuesday overnight DR sessions to analyze what happens when a short confirmation occurs between 4:30 and 5 a.m. You'll get the best retracement times, high probability retracement areas, and optimal target zones if this scenario unfolds. I will also show you how one session alone could have delivered a 14-hour trade or even more using the DR time and price strategy, combined with the understanding of DR Basics. This isn't based on subjective decision-making. It's purely backed by historical data, providing a measurable edge that separates professional traders from the rest. Let's take a closer look at this week's Tuesday overnight DR session. Since there was no confirmation in the first 30 minutes after the overnight defining range formed, our focus shifts to the next 30-minute window between 4:30 and 5 a.m. At 4:55 a.m., price confirms shorts, setting our parameters for data filtering. We're looking specifically at crude oil futures, the Tuesday overnight DR session, with a short confirmation between 4:30 and 5 a.m., assuming the session holds true. This is our playground for the session. For precise time and price trading, we will focus on three key factors: the best retracement time, the most probable retracement areas measured in standard deviations, and historically backed high probability target selection extracted from almost 2 decades of historical data. As time and price traders, we need a specific time window where we want to enter. That's why we filter by the median time of retracements, which covers 50% of all historical occurrences. This means that any retracement happening after this time window isn't relevant to our setup, and no trades should be taken after. QuantX refines the dataset and now shows only retracements that occurred up until 6:15 a.m., which is the median time. To have a better understanding, here's a visualization on the chart. Trades should only be taken in that time window. Every retracement after 6:15 a.m., we don't want to trade with time and price rules. Now we shift focus to price, where price is most likely to retrace within the defining range, measured in standard deviations. Why specifically inside the defining range? Under these exact conditions, there's an 88.1% probability that price will retrace at least back into the defining range, and a 79.1% probability that it will retrace into the implied defining range. That's a massive statistical advantage. If you've watched my last two videos, spotting the two high probability retracement areas should be second nature by now. One is from the 0 to plus 0.09 level, and the other is between minus 0.41 and minus 0.5. The 70th percentile retracement level sits at minus 0.4, and also worth noting. Here's the most important insight. Historically, maximum retracements have never occurred between minus 0.51 and minus 0.9 under these exact conditions. That's not just an edge, that's a major advantage for trade execution, stop-loss placement, and risk management. Now we need a high probability target for the session. Looking at the maximum extension distribution, one level stands out. The most frequently reached target sits at plus 2.9 to 2.99 standard deviations. That aligns closely with the median of plus 3 standard deviations, meaning it has been reached 50% of the time under these circumstances. For a safer target, going for the 70th percentile, which sits at plus 2.1, is considered a solid high probability approach. With our ideal time window for retracements, high probability price areas, and a statistically backed target marked on the chart, it's now just a matter of waiting for price to retrace into one of these areas before 6:15 a.m. Just 10 minutes after the confirmation, price reaches the first high probability retracement area. If entered, this would have been your first bullet for the session, unfortunately resulting in a loss. But here's where things get interesting. A deeper retracement into the second area follows, and take note of the time. It's the 5:20 a.m. candle. Looking at the maximum retracement time data one more time, this aligns perfectly with the cluster where most retracements historically occurred. There's another confluence here. The body of this candle respects a double intraday gap imbalance from the aftermarket DR session. If you've been following my content, you already know how important ADR gap imbalances are. A trade at this second retracement area, combined with the knowledge that price has never historically made a max retracement for the session beyond minus 0.51 to minus 0.9, allows for a highly confident stop-loss placement just above the mid-range. Targeting the 70th percentile, this setup offers a massive 14R trade backed entirely by historical data. Price drops below the defining range and the median time of maximum retracements is reached, which lets us assume this retracement is now locked in for the session. Ultimately, price reaches the 70th percentile target before the session ends. Later in the regular DR session, price continues lower, extending the overall move even further. This was a great example of how DR time and price traders use historical data to refine their execution and trade with precision. I hope this breakdown gave you new insights into data-backed trading strategies. If you found value in this, stay tuned for next week. Have a good day.
We're gonna take on the world.